I should say I've already had 10 or 15 minutes of conversation with Nouriel, so I'm at the edge of a breakdown already. So if I burst into tears here, you'll know why. Nouriel, thanks for joining us. In your recent work, you've talked about a kind of trifecta, economic trifecta that we're facing, where we have extremely loose monetary and fiscal policy on one edge of the trilemma. We have high debt on another edge, and we have supply shocks on the third corner. Yeah. Just start by talking a little bit about how those three pieces fit together and where that leaves us.
Yeah, well, the outcome of it is what I called eventually a stagflationary debt crisis. But the logic of the argument is as follows. If you look at debt ratios, both private and public, in the global economy, in 1999, they were about 220% of GDP. Today, they are 360% of GDP and rising. In advanced economies, it's 420 and rising. In China, it's 330% of GDP and rising. In a typical emerging market, it's 250 and rising, and most of it is in foreign currency. And this is not just public debts, also private debts. There have been a buildup of household debt, corporate debt, financial institution debt, you name it. And the problem, say, of Evergrande in China is just one of example of how much there is also debt, both private and public in China. And the question is how you're going to resolve this problem. Of course, right now, policy rates are low, zero or negative, long rates are low, so debt ratios are high, debt servicing ratios are low, and things look like sustainable. But things are going to change. And over time, I don't see a situation in which government spending as a share of GDP is going to fall. If anything, it's going to rise. There is so much income and wealth inequality that whether it's US, Europe, anywhere around the world, you're spending more as a way of a social safety net, given all the damages come from trade, migration, globalization, technology. The willingness and ability to raise taxes significantly on the wealthy, on the rich, is constrained politically, and of course, if you raise them too much, there'll be a damage to economic growth. And therefore, in my view, the path of least resistance is one in which essentially you want to wipe out the real value of nominal debt at fixed interest rate with gradually higher and unexpected inflation. So we have large private debt, we have large public debt. Central banks are not stupid or evil. It's just that economists used to worry about fiscal dominance, a situation in which public debt is so high that the central bank has to monetize it. But now it's not just public debt, it's also private debt. It's unprecedented. And if you were to try, say, when inflation rises, to try to tighten monetary policy and leave unconventional monetary policy, you'll have a bond market crash, you'll have a credit market crash, you'll have a stock market crash, you'll have an economic crash. And between that and keep on monetizing debts and wiping out the real value, I think that's going to be the path of least resistance. Second point, monetary policy has become very unconventional, both in terms of goals and tools. In terms of goals, we used to care only about inflation. Now, most places, a double mandate, growth and inflation. Now we care about financial stability, but financial stability means in good times we don't tighten to avoid bubbles, and when the shit hits the fan, then we backstop everybody, yes, increasing then public debt as a way of bailing out banks, corporates, households, you name it, over and over again. We care now about income and wealth inequality. That's an objective of the Fed. That means hot economy. We say that we care about asymmetries of employment. When undershoots, we care more than when it overshoots. We say that we're not going to fight inflation until we see the eye of inflation as opposed to using a Phillips curve. And now we also care about global climate change. That implies central bank are going to start to buy some of these green bonds and so on. So there's been a massive mission creep in terms of the goals. And some of these goals cannot be achieved, like income inequality or climate change, by using monetary policy. And on the tool side, as everything's become unconventional. I used to teach macro 20 years ago. The only policy rate was short-term overnight rate, the Fed funds rates, and you do open market operation. Now we've gone to zero policy rates, negative policy rates, quantitative easing, credit easing, forward guidance, yield curve control, and now there is effective, not just talk, but practice of variants of modern monetary theory, helicopter drop of money, If we're going to go a central bank digital currency, we're going to even be going more negative with the policy rates, with more financial repression. So we are in a world in which essentially monetary and fiscal policy are becoming loose, and the temptation to wipe out the real value of the debt through inflation is going to be there.
And why can't that be done in a more or less benign, relatively stable, long-term process where we run the economy relatively hot, we get some growth, but we have enough inflation that the debt burden becomes lighter gradually over time?
Well,
what upsets that equilibrium?
In order to reduce debt ratios that are so high and unsustainable, first of all, going from 2% to 3% inflation is not going to be enough. You need to have significant unexpected inflation that wipes out some of the real value of long-term fixed rates debt. And by the way, a lot of debt eventually is going to be shorter term and has to reprice. Some of the debt is in foreign currency, so for emerging markets, that option of wiping out with inflation is not there, and you have to outright default. And even if central banks remain behind the curve and they don't tighten enough, so real rates don't rise and only inflation expectation rise, eventually with high and volatile inflation risk premia become higher, and therefore real rates are going to rise. And therefore, eventually, those debt ratios are going to become unsustainable. Some of the nominal fixed rates are going to be wiped out, but the stuff is going to reprice with higher risk premia for inflation are going to imply eventually a debt crisis. That's why eventually I think inflation is not the solution to this debt problem, but it's going to be used together with some degree of financial repression. But the other point I make, that is the third leg of the argument, is that while in the short run right now people are worried about this slowdown of growth and rising inflation because of short-term supply bottlenecks that we know about, goods markets, labor markets, this mini kind of stagflation where growth is lower and inflation is higher, at least this quarter. My view of it is that actually there are some forces that imply there'll be negative supply shocks over the medium term, that like in the 1970s are going to end up with stagflation, where negative supply shocks occur and then central banks and fiscal authorities have loose monetary and fiscal policies. Now, in the 70s, as you remember, there were the two sudden shocks of the Yom Kippur War, the Israel and Arab states 73, and then in 79, the Iranian Revolution. I've identified 9 forces that are the reversal of factors that for the last 30 years were keeping inflation low. Those factors were keeping inflation low and were structural and global. Now they're reversing themselves. Factor number 1, we are in a process of deglobalization, protectionism, and restrictions of trade in goods, in services, in capital, in labor, data, information, technology. It's gradual, but is occurring for lots of reasons why there's a backlash against trade, migration, globalization. Secondly, we have this balkanization of global supply chains, not just because of pandemics, but also factors that are in part geopolitical. 3, we have aging of population, both in advanced economies, but also in major emerging markets like China, Russia, Korea, and parts of Asia. The increase in the supply of labor from China joining the global labor supply and still young people in the West kept inflation at bay for the last 30 years. The reverse occurred. 4th, we're now restricting migration from the poor South to the rich North in the US, in Europe. The migration policy of Biden are not going to be any different from Trump. We're not going to let millions of refugees, either because of social strife, political, economic, or climate change coming to the United States. It's going to be restricted in US, in Europe, everywhere around the world. And that migration kept the lead on wage growth. Moreover, we have this Cold War between US and China, decoupling on technology, on trade, data, information. And I'll give you just one example of how that's a negative supply shock. Suppose we decide that we don't want to use the 5G of Huawei because it's a backdoor to the Chinese government. They're going to listen to us. But we use Nokia and Ericsson. The Nokia and Ericsson system costs you 30% more and is 20% less productive. So to build the same 5G network is going to cost you 50% more. That's a negative supply shock. We have now this fight on semiconductor. 50% of global supply from Taiwan, 80% of the high end from Taiwan. You know, the FT during the summer had a cover story saying, what's the most dangerous place in the world? A map of Taiwan and a target. And now the Chinese are hoarding all the semiconductors because, you know, we're going to cut them off. And now they have supply problems from auto to consumer electronic. If there was a tension of this Cold War getting colder, You could have, literally supply of semiconductors shutting down, a bigger oil shock, a bigger shock than the oil shock. So the decoupling to the US and China is a leading, again, fragmentation of the global economy in a way is a negative supply shock. Then we have global climate change, in my view, negatively affects stagflation for three reasons. One, there is not enough water, but not just in sub-Saharan Africa or Middle East. Look what's happening in the west of the US. In California, the farms are selling their water rights for other people. 1/3 of all fruits are in California, of all vegetables. 2/3 of fruits and nuts are from California. There are fights on water rights between counties and states. This is a 40-year drought. Cattle, all this rest is going to be like this. Second element of climate change is going to lead to a oil shock is that we're rightly bashing carbon and fossil fuels, and now financing for fossil fuel investments is reduced. And everybody in big oil says, okay, I should underinvest into fossil fuel. But in my view, the increase in green energy and renewables is going to occur very slowly compared to the rise in demand. So if you bash big oil and there's not going to be enough production of essentially fossil fuels and the renewable energy is not going to rise enough, eventually we're going to have an oil shock, for example. Pandemics, of course, are leading to a situation where now people want to be self-sufficient, restrict exports, they balkanize the supply chains. Cyber warfare is becoming a huge problem. Every other day there is a pipeline or a beef producer is shut down, and that's a negative supply shock. It's going to get worse. Or if you want to control it, you have to spend hundreds of billions of dollars for trying to protect yourself against it. It's going to be cost of production. And final factor, ninth, is that now there is a massive backlash against income and wealth inequality because there has been such a rise in inequality. I mean, out of the $1.9 trillion of the first Biden package, 90% of it went to worker, unemployed, partially employed workers, minorities, all that's left behind. Rightly so, because the rise of inequality eventually leads to social strife. But if the reservation wage is going to increase,
yes,
you're going to have an increasing wage growth, and then the beginning of a wage and price spiral that also is going to be stagflationary. So these are shocks that are gradual. They're not occurring overnight, but you combine essentially a bunch of negative supply shocks over the medium term together with loose monetary and fiscal policy that you need to avoid market crashing. And that combination of overheating on the demand and the negative supply shock eventually leads you to stagflation. And the final point on that is the following one. In the 1970s, we had stagflation because of loose monetary and fiscal policy and negative supply shock, but debt ratios were 1/3 of what they are right now. After the global financial crisis, we had a debt crisis because there was too much private and public debt around the world, but because this was a demand shock and a credit crunch, we had lowflation, if not deflation. So we didn't have inflation. Today, instead, I fear that we're going to have the worst combination of the 1970 stagflation because of loose policy and negative supply shock with debt ratios that are 4 times as high overall as they were in the 70s. And only inflation is going to wipe out only some of it. Once things reprice, real rates are going to rise. So we're going to have a stagflation and a debt crisis. That's what I call a stagflationary debt crisis. Now,
but
it's not an argument for the next
6 months. It's the debt crisis that kills growth.
The negative supply shocks by themselves can kill growth. If they become significant enough, growth can slow down significantly while inflation is rising. So that's already stagflationary. And then if the ratios are so high and inflation doesn't wipe out them, and then things reprice in terms of real rates and inflation risk premia, then you end up also with a debt crisis. So the worst of the 70s in terms of stagflation and the worst of the post-GFC in terms of debt ratios that are unsustainable. I think it's a slow motion train wreck. It's not a prediction for what's going to happen to the market in the next 3 months or 6 months, but over, say, the next 2 or 3 years, that's what I see the major risk to the global economy.
Does anybody else need a drink, or I'm going to be... okay, I'm going to try for optimism here.
Yeah.
It seems like some of the supply shocks that you have discussed are linked. Deglobalization, the Cold War, semi-Cold War with China, the supply chain balkanization, all of these, even migration, are linked. All of these are basically political problems and are tied to the global political climate. And those problems seem acute right now, but unlike some of the other problems, those are political problems with political solutions. In other words, the upside risk to your thesis might be that we do a little better politically and relieve some of those potential supply shocks.
Well, you know, politically, I would say geopolitics, unfortunately, is leading to this Cold War between US and China becoming colder, and some people even worry about eventually actual war occurring on Taiwan or South China Sea. I don't know whether a real war is going to occur, but certainly all the trends are ones of a decoupling between US and China. It's going to imply that there's going to be fragmentation of the global economy, globalization of global supply chains, decoupling certainly in technology. But I'll give you an example of how decoupling in technology leads also decoupling in trade. Today, the 5G network, as I said, we're not going to use the Chinese one because it's a backdoor to the Chinese government, and that's fine. Because otherwise they can listen to our conversation. But tomorrow, think about the system of autonomous vehicles that have all to move together without hitting each other. It's a combination of AI, machine learning, the IoT with the sensors that pick up all the data, and then a 5G or a 6G system that makes sure that all these cars don't hit each other. Now, in a world in which there is decoupling on technology, today already the Chinese are telling Tesla, I don't want you to collect the data on the Chinese drivers because maybe you're going to pass it to the NSA. And in the US, we're telling the Chinese, we don't want you to use TikTok or control TikTok or grinders because you could blackmail gay people or the young people could be manipulated. So the future of trade is not anymore goods and services traditionally, it's data. Data is going to be the key for the future. And once we're starting to restrict trade because of politics, because of geopolitics, in Europe because of privacy and so on, that again is a form of decoupling that is damaging global supply chains and integration of the global economy. And by the way, today is the 5G in the cell phone. Tomorrow is the 5G that operates our autonomous vehicles. But tomorrow, every piece of consumer electronic, even your lowly Chinese toaster or microwave or coffee machine, is going to have a 5G chip because it's going to be the Internet of Things. We can remotely turn on remotely our coffee machine or microwave and so on. All these essentially billions of different types of consumer electronic products, even the most lowly ones, are going to have a 5G chip. So pretty much even your coffee machine can be a listening device for the Chinese government if it has a Huawei 5 chips. So once you restrict the 5G on the telecom, eventually you'll have to also tell no Chinese toaster, no Chinese coffee maker, no Chinese, I mean, it's extreme.
Yes.
But in a world in which everything is 5G, everything is integrated, everything is data, everything has a sensor, you know, already the drones from China are at risk. But this is just a slippery slope that from restricting trade in technology implies restricting trade in everything. And then you have two different worlds, completely decoupling between West and the East. That's the direction you go once you go in that direction.
How are we doing for time? Do we have 5 more minutes? Or we're done. Okay. Well, the optimists in the audience will be relieved. Thank you very much, Nouriel.
Yeah. Okay.
Very helpful.
Happy to cheer you up. Thanks.
That was great.
Thanks.
Sorry we didn't have more time.